There is a number following you everywhere you go. It is there when you apply for the apartment you want. It is there when you finance the car. It is there when the mortgage officer pulls your file and decides, in the space of a credit check that takes 30 seconds, whether you will pay 6.5% interest or 7.8% interest on the largest purchase of your life. It is there when you apply for the business loan. In some states, it is even there when your car insurance company calculates your premium. The number is your credit score, and the gap between a good credit score and a great credit score, the gap between 700 and 780, between adequate and excellent, can cost you, over the course of a lifetime of borrowing, more than $100,000 in additional interest payments. Most women know their credit score matters. Fewer know exactly how it is calculated. Almost none know the specific counterintuitive behaviors that improve it fastest. Behaviors that are so simple, so non-obvious, and so rarely explained clearly that I genuinely believe the financial industry's silence on them is less accident than strategy. Because a woman who understands exactly how her credit score works does not need the expensive credit repair services that generate billions in revenue every year. She does not need the secured credit cards with the outrageous annual fees. She does not need the credit monitoring subscriptions that charge her monthly to watch a number she could improve herself for free. She just needs to know 5 things. 5 things that most people, including most people who think they understand credit, have never been told clearly or completely. Zoe, who you met in scripts 4 and 6, has a credit score of 687. She thinks of it as good. Her bank told her it was good. The credit card company that approved her last year told her it was good. She has never been declined for anything she applied for, which feels like evidence that good is fine. It is not fine. 687 is the difference between the best mortgage rate available and a rate will cost her on a $350,000 30-year mortgage an additional $47,000 in interest payments from one number that nobody told her how to improve. Naomi, who you met in scripts 2 and 5, has a credit score of 794. She has never paid a credit repair service. She has never taken a secured card with a fee. She has never done anything dramatic or expensive to build her score. She has done 5 specific things consistently for 4 years. The same 5 things we are going to go through today. By the end of this video, you will understand your credit score at a level most people never reach, and you'll know exactly what to do this week to start moving it in the right direction. How your credit score is actually calculated. Before the 5 moves, you need to understand the formula, because the formula is where most people's instincts lead them wrong, and where the loopholes live. Your FICO credit score, the score used by 90% of American lenders, is calculated from 5 factors. Most people know they exist. Almost nobody knows how they are weighted. The weighting is where the strategy lives. Payment history, 35% of your score, the single largest factor, whether you pay your bills on time every time. A single missed payment, one bill 30 days late, can drop a good credit score by 60 to 110 points. A single missed payment on an excellent credit score can drop it by more than that. Set up automatic minimum payments on every account, so a forgotten bill never becomes a missed payment. This is the non-negotiable foundation. Everything else on this list is optimization. This is survival. Credit utilization, 30% of your score, and where the loophole lives. This is where most people's instinct is wrong, and this is where the loophole is. Credit utilization is the percentage of your available credit that you are currently using. If you have a $10,000 credit limit and a $3,000 balance, your utilization on that card is 30%. Most people have been told to keep utilization below 30%. That advice is correct, but incomplete. The research on score optimization shows that the highest credit scores, 780 and above, are typically associated with utilization below 10%, not 30%, 10%. Here's the counterintuitive part that most people never hear. Your credit utilization is calculated based on the balance reported to the bureaus, which is the balance on your statement closing date, not your payment due date, which means even if you pay your credit card in full every month, even if you carry 0 debt ever, your reported utilization may be 20, 30, or 40% because the balance from your spending during the month was reported before you made the payment. Zoe pays her credit card in full every month. She has no credit card debt. Her reported utilization is 34% because she uses the card heavily for her monthly expenses, and the statement balance is reported before she pays it. Her score is being held down by a debt she doesn't carry. The fix, and this is the loophole, is to make a payment before your statement closing date, not after. Before. If your statement closes on the 15th of the month, make a payment on the 12th. The balance reported to the bureaus reflects the lower number. Your utilization drops. Your score improves. You have not changed your spending. You have not changed your payment behavior. You have changed the timing of one payment. That is the entire intervention. Zoe implemented this one change and her score moved from 687 to 714 in 60 days. From one timing adjustment on an account she was already managing well. Length of credit history. 15% of your score. The longer your accounts have been open, the higher this component of your score. This is why the instinct to close old credit cards, cards you do not use, cards from a previous phase of your life, is almost always wrong. Closing an old card reduces your average account age and reduces your available credit, which also increases your utilization. Two negative effects simultaneously. Keep old accounts open. Use them occasionally. Pay the balance in full. Let them age. Credit mix. 10% of your score. Having different types of credit, revolving credit like credit cards, and installment credit like car loans or student loans, demonstrates to lenders that you can manage multiple types of debt responsibly. For most women, this factor manages itself over time. But for women who are thin file, rebuilding credit after divorce, returning to independent financial life after financial dependence, starting from scratch with no individual credit history, a credit builder loan is one of the most practical tools available and one of the least discussed. A credit builder loan is a small loan, typically $300 to $1,000, offered by credit unions and some online banks specifically for credit building purposes. You do not receive the money upfront. The bank holds it while you make monthly payments. At the end of the loan term, you receive the money plus whatever interest it earned while held. The loan reports to the credit bureaus monthly as an installment account with a perfect payment history. It builds credit mix and payment histories simultaneously, costs very little in interest, and takes 12 to 18 months to complete. For Diane, who you met in Script 1, the woman who found herself at 44 in a lawyer's office looking at financial documents she had never seen, a credit builder loan alongside the authorized user strategy in Move 3 represents the fastest legitimate path to a meaningful individual credit score without taking on real debt. The combination can move a thin file score by 60 to 100 points within 18 months. Available at most credit unions, free to set up, no credit repair service required. New credit inquiries, 10% of your score. Every time a lender performs a hard inquiry on your credit, when you apply for a new card, a loan, a mortgage, your score drops slightly, typically 5 to 10 points. The drop is temporary and recovers within 12 months. The rule: apply for new credit only when you need it. And when you are shopping for rates for a mortgage or car loan, where multiple lenders will each pull your credit, do it within the 14 to 45-day window. The scoring models treat multiple inquiries for the same type of loan within that window as a single inquiry. Shop for rates, do it quickly, do it within the window. The 5 moves. Move 1, pay before your statement date, not after. This is the loophole, the one that moved Zoe 27 points in 60 days without changing a single spending behavior. Find your statement closing date for every credit card you own. It is in your account settings or on your most recent statement. Set a calendar reminder for 3 days before that date every month. On that reminder date, log in and make a payment that brings your balance below 10% of your credit limit. If your credit limit is $10,000 and your current balance from the month's spending is $3,200, pay $2,200 before the statement closes. The reported balance will be $1,000, 10% utilization. The bureaus record the lower number. Then pay the remaining $1,000 on your normal payment date. You have paid the same amount you always paid. You have simply moved part of the payment 3 days earlier. The score improvement from this single habit is the highest return on time invested of anything on this list. 1 calendar reminder, 1 earlier payment, 27 points in 60 days. Move 2. Request a credit limit increase, but do not use it. Your credit utilization is a ratio. If you increase the denominator, your credit limit, without increasing the numerator, your balance, the ratio improves and your score improves. Call your credit card company and request a credit limit increase. Most major issuers will grant a modest limit increase to customers in good standing without a hard inquiry if the increase is reasonable. Ask specifically whether the review will require a hard inquiry before they proceed. If they say no, proceed immediately. If they say yes, evaluate whether the utilization improvement outweighs the temporary score reduction from the inquiry. In most cases, if your utilization is currently up 20%, it does. Naomi requested a limit increase on her primary card from $8,000 to $14,000 18 months ago. Her average monthly balance did not change. She continued spending approximately $1,800 a month. Her utilization dropped from 22.5% to 12.9%. Her score increased by 18 points from that single phone call. Do not use the increased limit to spend more. The limit increase is a utilization management tool. The moment you begin spending to the new limit, the benefit evaporates entirely. Move 3. Become an authorized user on a long-standing, well-managed account. This is the move most people have never heard of and the one with the fastest potential score impact for women who are rebuilding credit or building it from scratch. When you are added as an authorized user on another person's credit card account, a parent, a partner, a sibling, that account's full history appears on your credit report. Its payment history, its credit limit, its age, its utilization, all of it. You do not need to use the card. You do not need to be given the card. You simply need to be added to the account. If your mother has a credit card she has held for 20 years, paid on time every month with a high limit and low utilization, and she adds you as an authorized user, 20 years of perfect payment history appears on your credit report immediately. Your average account age increases, your available credit increases, your payment history improves. Your score can move 40 to 80 points in a single credit bureau update cycle. The account holder assumes no financial risk from adding you. The card can remain in their wallet. The benefit to your score is immediate and significant. For Diane, at 44, starting over with a thin individual credit file, this approach combined with a credit builder loan represents the fastest, legitimate path to a meaningful credit score without taking on real debt or paying for services that charge hundreds of dollars to provide information available freely. Move 4. Dispute every error on your credit report, because there are probably errors. The Federal Trade Commission found that 1 in 5 Americans has a significant error on at least one of their 3 credit reports. 1 in 5. Errors that are lowering their score. Errors they have never checked for, because checking your own credit report is not a habit most people have been taught to maintain. You are legally entitled to a free copy of your credit report from each of the 3 bureaus, Equifax, Experian, TransUnion, every 12 months at annualcreditreport.com. Pull all 3, check every account listed, verify that every payment history entry is accurate, look for accounts you do not recognize, look for addresses you have never lived at, look for hard inquiries you do not remember authorizing. Zoe pulled her reports as part of the financial inventory process we covered in Script 6. She found 2 errors: a missed payment recorded on an account she had paid on time, and a collection account that belonged to someone with a similar name. She disputed both through the Bureau's online dispute process. Both were removed within 35 days. Her score improved by 31 points from the corrections alone. The dispute process is free. It takes approximately 45 minutes for a report with identified errors. The potential score improvement from removing inaccurate negative items is the most underutilized free score improvement available to most consumers. 1 in 5 people have an error that is costing them points. 45 minutes could be worth more than any financial product you have ever purchased. Move 5. Stop closing old accounts and start managing them intentionally. The instinct to close credit cards you do not use is almost universal and almost always counterproductive. Every account you close reduces 2 components of your score simultaneously: your average account age and your total available credit. Both reductions work against your score at the same time. Carmen closed 3 old credit cards 2 years ago because they felt like clutter. She did not have balances on them. They felt unnecessary. Her score dropped 44 points from the 3 closures, a combination of reduced average account age and reduced available credit that increased her utilization ratio on the remaining accounts. She cannot reopen those accounts. The history they represented is gone from her credit report. What she can do, and has done, is manage her remaining accounts intentionally with the 5 moves on this list. Her score has recovered to within 12 points of where it was before the closures. It will take another 18 months to fully recover. Keep the old cards. Use them once a quarter for a small purchase, a coffee, a grocery item, anything that keeps the account active. Pay them immediately and in full. Let them age. A card that has been open for 8 years with a perfect payment history is one of the most valuable assets in your credit profile. Treat it accordingly. Zoe's credit score when we began this story, 687. Naomi's, 794. The gap, 107 points. The financial cost of that gap on a $350,000 mortgage, approximately $47,000 in additional interest over 30 years.
Zoe implemented all 5 moves. The payment timing change was immediate. 1 calendar reminder, 1 earlier payment. The statement balance reported at 8% utilization instead of 34%. The limit increase request took 1 phone call. The authorized user arrangement took a conversation with her mother, who added her to a 22-year-old account with a perfect payment history. The credit report dispute took 45 minutes and removed 2 errors that had been suppressing her score without her knowledge. The old account management required stopping 1 action she had been about to take, closing a card she had decided was clutter, and replacing it with a quarterly small purchase and immediate full payment. 6 months after implementing the 5 moves, Zoe's score is 741, not 794, not Naomi's number yet.
But 741 is a different mortgage rate than 687. 741 is the rate tier that saves her $31,000 in interest on her eventual mortgage compared to where she started. She has not yet bought the house, but when she does, the credit score she brings to the conversation will be one she built deliberately, with full understanding of how the number works, without a single dollar paid to a credit repair service. The loophole was never a secret, it was just never explained. 5 factors, 5 moves, 1 number that follows you everywhere and costs you $47,000 if you leave it at 687 when it could be 780. Payment history is 35% of your score. Automate every minimum payment. 1 missed payment undoes years of positive history. This is the foundation. Everything else is optimization built on top of it. Credit utilization is 30% of your score. Keep it below 10%. Pay before your statement date, not after. Request limit increases you do not intend to use. This is where the loophole lives, and it is available tonight. 1 calendar reminder. Length of credit history is 15%. Keep old accounts open. Use them occasionally. Let them age. Never close a card because it feels like clutter. The history is the value. The card is just how you access it. Credit mix is 10%. For most women, this manages itself. For thin-file women rebuilding after financial dependence, Diane's situation, a credit builder loan at your local credit union builds payment history and credit mix simultaneously, without real debt. 12 to 18 months, available for free. New inquiries are 10%. Apply for credit only when you need it. Rate shop within the 14 to 45-day window. Multiple inquiries for the same loan type in that window count as 1. And pull your credit report from all 3 bureaus tonight at annualcreditreport.com. 1 in 5 people have an error that is costing them points. 45 minutes and a dispute form could be worth 30 points and $31,000 in future interest savings. Zoe found 2 errors she did not know existed. You might too. Your 1 action tonight is to go to annualcreditreport.com and pull your free credit report from all 3 bureaus. Not to check your score, you can see your score on most banking apps already. To check for errors. Specifically, look for payment history inaccuracies, accounts you do not recognize, and hard inquiries you did not authorize. If you find any, the dispute process is free and takes under an hour. While you have the report open, find the statement closing dates on each of your credit cards. Set a recurring calendar reminder 3 days before each one. Starting with the next statement cycle, make a payment before the closing date that brings your balance below 10% of the limit. Those 2 actions, the error check and the payment timing shift, are available to you tonight, cost nothing, and could move your score 20 to 50 points within the next 60 days. Zoe moved 27 points from the timing shift alone. The error dispute added 31 more. That is 58 points from 1 evening and 1 calendar reminder. I will link the annualcreditreport.com website, a step-by-step dispute guide, and a list of credit unions offering credit builder loans in the description. Next week, we are talking about something this community has been asking for since Script 1, the paycheck routine, the specific step-by-step system for what to do with every dollar the moment it hits your account. Not a budget, not a spreadsheet, a routine. The same routine that Kelly from Script 2 has been running for 4 years, the one that turned $73,000 per year into $89,000 in savings, while Tracy was turning $82,000 into $5,200. The routine is simple. It takes 15 minutes per paycheck. It is the system that makes every rule on this channel automatic rather than aspirational.
Subscribe so you're there. Share this video with the woman in your life who knows her credit score matters and has never been told how it actually works. She's been flying blind in a system that profits from her not knowing. This video hands her the map. Make sure she gets it.